You've probably never heard of it, but it's quietly creating billionaires faster than tech startups. It's not crypto, it's not AI, it's something far less flashy and way more mysterious. It's called private credit, and over the past decade, this under-the-radar financial engine has ballooned into a $1.5 trillion force, nearly 10 times larger than it was before the 2008 financial crisis. It's handing out eye-popping returns, snatching up top Wall Street talent, and turning financial firms into wealth machines overnight. Big names like Apollo Global Management, Ares Capital, and Blue Owl Capital are leading the charge, making billions from something most people don't even understand. In fact, many of the world's largest pension funds, endowments, and even regular investors are now pouring their money into it, chasing returns in a market where traditional lending and stock investments just aren't cutting it. But here's the kicker. Despite its explosive growth, private credit operates in the shadows, almost entirely outside the traditional banking system. There are no federal stress tests, no public disclosures, and virtually zero regulatory oversight. It's booming, it's risky, and it's reshaping the future of finance in ways that could either build empires or blow holes through the economy. So what exactly is private credit, and why is Wall Street treating it like the next gold mine? At its core, private credit is simple. It's when non-bank institutions like private equity firms, asset managers, or specialized credit funds lend money directly to businesses. These aren't your everyday small business loans or SBA programs. We're talking about large, often risky loans made to companies that banks don't want to touch anymore. Here's the catch. After the 2008 financial crisis, the US government imposed strict regulations on traditional banks. These rules limited how much risk banks could take with their depositors' money. That left a giant hole in the lending market, especially for companies with lower credit ratings or more unpredictable cash flows. Enter private credit. These firms stepped in and said, hey, we'll lend you the money the banks won't, if you're willing to pay a higher interest rate. And that's how they started raking in serious profits. In some deals, firms earn double-digit interest along with upfront fees, equity kickers, and tight control over the borrower's finances. And unlike stocks, which swing with the market, private credit promises a steady drip of cash, interest payments over time. To big investors like pension funds and endowments, that's gold. It offers the dream combo, high returns and predictable income. But there's a reason banks walked away from these loans. They're risky. If the borrower defaults, the entire investment can sour quickly. Still, that hasn't stopped the money from pouring in. In 2010, the private credit market was around $200 billion. Today, it's estimated at over $1.5 trillion and climbing, one of the fastest growing asset classes on the planet. It's high risk, high reward, and right now, it's red hot. Private credit isn't just making money, it's minting moguls. In the last decade alone, the explosive rise of this once obscure lending market has catapulted a handful of financial insiders into billionaire status. These aren't flashy tech founders or hedge fund rock stars. They're credit kings, masters of lending in the shadows. Firms like Apollo Global Management, Ares Management, Blue Owl Capital, and Oak Tree Capital have led the charge. By offering loans to high-risk companies shut out of traditional bank financing, these firms collect massive interest payments, charge high upfront fees, and sometimes even secure equity in the business. The payoff? Enormous recurring cash flow and long-term ownership stakes, all without buying the business outright. It's a model that works really well. Mark Rowan, the CEO of Apollo, has seen his net worth skyrocket as the firm became one of the most dominant forces in private credit. Blue Owl, a younger player in the space, has grown rapidly and is now managing over $165 billion in assets, earning its founders billionaire status in record time. And it's not just the founders. Young professionals straight out of Wharton or Harvard are skipping traditional Wall Street firms like Goldman Sachs to work for private credit giants. Why? Better pay, better hours, and a front row seat to a booming business. This new billionaire class didn't invent a flashy product. They rebranded an old idea, debt, and turned it into a financial juggernaut. While Silicon Valley builds apps, these guys are building empires with contracts, collateral, and compounding interest. The explosive growth of private credit wasn't just a stroke of luck. It was driven by a series of financial shifts that created the perfect opening. It started after the 2008 financial crisis, when regulators tightened the leash on traditional banks. Laws like Dodd-Frank made it harder and riskier for banks to lend to companies with shaky credit or inconsistent cash flow. That left thousands of businesses in a tough spot, too big for local banks, too unpredictable for the big guys. Suddenly, a huge gap in the lending market appeared. Private credit firms saw the opportunity and moved fast. Since they weren't banks, they weren't bound by the same restrictions. They could take on riskier loans, act faster, and design deals that traditional institutions couldn't. Companies got the funding they needed, and private lenders got high returns in exchange. At the same time, interest rates across the U.S. were at historic lows. Safe investments like government bonds were barely paying anything, so institutional investors, like pension funds, endowments, and insurance companies, started looking for alternatives. Private credit, with its promise of 8% to 12% returns and steady cash flow, became a hot ticket. Billions poured in from investors hungry for yield in a world where yield was hard to find. Meanwhile, private credit firms also started attracting top talent. Grads from elite schools began skipping over big investment banks and heading straight for firms like Apollo and Blue Owl. The hours were better, the money was strong, and the path to real influence was faster. Suddenly, private credit wasn't just profitable, it was aspirational. And let's not forget the companies themselves. For many of them, private credit offers flexible terms and fast cash. They don't need to go public, deal with quarterly earnings, or jump through regulatory hoops. That kind of financing freedom is rare and incredibly valuable. All of this created a snowball effect. More demand, more investors, more deals. And with every deal, the industry grew bigger, bolder, and richer. For all the wealth private credit has created, there's a darker side to the story, and it's one that's starting to worry economists, regulators, and even some insiders. The first red flag? Regulation, or rather, the lack of it. Unlike banks, which are closely monitored by the Federal Reserve and required to undergo regular stress tests, private credit firms operate almost entirely in the dark. There are no standardized disclosures, no federal oversight, and no real way for outsiders, or even investors, to know how risky the loans truly are. That means billions are being lent to companies without the usual safety nets. If a borrower defaults, there's often no public reporting, no immediate intervention, and no guarantee that investors will get their money back. It's a financial black box. And as the size of that box grows, so does the potential fallout if something goes wrong. Then there's the issue of transparency. In many cases, even the firms making the loans don't fully know the financial health of the companies they're lending to. Some loans are tied to complex revenue streams, like subscription services or even plastic surgery payments. Others are backed by royalties from music catalogs or gym equipment contracts. The weirder it gets, the harder it becomes to assess risk, and complexity, as always, breeds danger. Now add a fragile economic backdrop to the mix. Interest rates are rising, which means companies have to pay more to service their debt. At the same time, revenue growth is slowing in many industries. That's a dangerous combination. In fact, recent data shows that more than a third of private credit borrowers now owe more in interest than they generate in earnings. That's a recipe for defaults. And defaults are already starting to trickle in. Companies like Chicken Soup for the Soul, CoreWeave, and Zips Car Wash have all struggled to meet their payments. These are just a few early warning signs, but they could be the canary in the coal mine, because private credit hasn't yet been tested in a full-blown recession. And if the economy hits the brakes, the cracks in this $1.5 trillion industry might become a full-blown fracture. Private credit isn't slowing down. In fact, it's just getting started. Analysts estimate the market could triple in size by 2030, reaching over $4 trillion globally. That kind of growth is staggering. But with it comes a big question. How do you scale a system this fast, this big, and still keep it stable? Wall Street is already adjusting. Major banks, ironically, the very institutions private credit was meant to replace, are now piling in. JP Morgan, Goldman Sachs, and others are launching their own private credit arms or partnering with existing firms. Why? Because they see where the money's going and they don't want to be left behind. Even retail investors are getting a slice of the action. New financial products are being developed to allow individuals, normal people, to invest in private credit through mutual funds and fintech apps. That might sound like democratization, but it also introduces volatility. Regular investors don't have the patience or risk tolerance of institutions. If markets tank, they could rush to pull their money out, triggering a liquidity crisis. There's also mounting pressure on regulators. Senators and economists are calling for greater transparency, stronger reporting requirements, and clearer rules for how these loans are originated, valued, and managed. But private credit firms are fighting back. More regulation means slower deals and thinner margins, and they're not giving that up easily. So where does that leave us? Private credit is poised to keep growing, reshaping how businesses get capital and how investors seek returns. But if it's going to be part of the financial system for the long haul, it may have to grow up fast, because what was once a niche, unregulated corner of finance is now big enough to shake the entire system. Private credit may sound dull on the surface, but beneath it lies one of the most powerful and risky shifts in modern finance. It's made billionaires out of deal makers. It's pulled in trillions from investors, and it's rewriting the rules of lending, one high-risk loan at a time. But the same traits that make it profitable, speed, opacity, and size, also make it fragile. With no regulatory net and a growing appetite for risk, private credit could be building the next big boom or the next financial bust. This is the mysterious new industry cranking out billionaires, and maybe, just maybe, future headlines too. Do you think private credit is a smart evolution in lending, or are we sleepwalking into the next financial crisis? If you found this breakdown helpful, make sure to like, subscribe, and drop a comment with your thoughts.